It's time for Ask Annex. As always, you've got a question for us, please head to our website. It's annexwealth.com. Look for the Ask tab. We get back to everybody. We need your permission to go on the radio, and if you don't want to, that's fine. We'll just keep that internal. Sarah Kyle's a wealth manager at Annex Wealth Management. She's here. Hey.
Hey, Danny.
Let's welcome in Trevor Nargis, senior trader at Annex Wealth Management. Good to see you.
Hello.
Trevor is a regular guest on the Annex Wealth Management SWAT podcast, if I want to put a plug in for that. First question is from Anthony. I have a full-time job with full health care coverage and plan on continuing to work. Should I sign up for Medicare to avoid any penalty, even though I do not want or need it now? It's my understanding that I should not. I turned 65 in a week and a half. Many thanks.
Well, happy early birthday, Anthony. So the first thing is to ask your employer to see if you even need to sign up for Part A and Part B when you turn 65. Generally, if your employer has at least 20 employees and you are still working and covered under that qualified group plan, when you do turn 65, you can delay the enrollment in Medicare. But at a minimum, signing up for Medicare Part A is best practice since it is free and you will get some coverage for hospital-related costs. However, this is a big however, this only makes sense if you aren't contributing to an HSA. So once you sign up for Medicare, you are no longer eligible to contribute to one. And you know what? It's a good idea just to run the numbers. Make sure if your employer plan isn't heavily subsidized by the employer, it may make sense to get on Medicare. So figure out what you're paying, what your benefits look like under your group plan, and compare that to Medicare, taking into account the cost of everything from premiums to copays to deductibles.
That's the way we think. Let's go to Karen's question. What does risk mean in investing?
Yeah, so that's a fantastic question, right? Risk can be defined by a plethora of different things, right? There's all different types of subsets of risk in investing, but the Financial Industry Regulatory Authority, so that's commonly referred to as FINRA, but they define risk as any uncertainty with respect to your investments that has the potential to negatively impact your financial welfare. So like I said, right, there's different components to risk. You got systemic risk, interest rate risk, liquidity risk, so on and so forth. But in short, risk is viewed by many as the potential for loss of capital. Now, some people will take volatility and they'll group that and risk together. But volatility really pertains more to the range of price movements in securities over a certain time frame. Risk, on the other hand, that should be thought of from more of a long-term standpoint. So in properly functioning markets, participants should be compensated with higher returns for the higher levels of risk that they take.
Sarah, do you find that risk tolerance is that a gut thing with people?
Well, it's definitely a measure if you can sleep at night.
Yeah.
We always talk about the tolerance versus the capacity in your portfolio.
And they're different.
In your plan.
Yeah. Mm-hmm. Next question is anonymous. What are the most common types of bridge insurance if I retire early? I have 2 years before being eligible for Medicare.
Well, the most common bridge is Obamacare, but that depends on income. So some people choose to do COBRA because it's actually cheaper.
You have to weigh that. Mm-hmm. But the exchange or the Obamacare,
yep.
Right? Okay.
Yep.
And our final question is also anonymous. How rare is it to hold on to stock for years or even decades? Isn't that what Warren Buffett does?
Yeah, this is a great question. It's always fun to, talk about Warren Buffett here and there. So for starters, it really depends on one's time horizon and what they're looking to accomplish with their portfolio. For some people, buying and holding makes a lot of sense. Whereas for others, a more hands-on approach can help in navigating different market environments. Over time, according to a study done by Reuters, the average investor's holding period of shares on the New York Stock Exchange has actually fallen quite a bit over time. It's really been driven by the emergence of algorithms, high-frequency trading, lower commissions and fees on trades, shorter company life cycles, and in general, you have people who are focused a lot more on kind of the short-term performance. Back in the late 50s and the early 60s, the study that I just mentioned, that showed that the average holding period for a stock was actually around 5 to 8 years. And we've seen a steady decline in that holding period over time. Now, the average holding period for a stock on the New York Stock Exchange is sitting at about 5.5 months. So to get at the first part of that question, right, it's become more uncommon to take the buy and hold approach.
Sarah, do you find sometimes after a potential client has gone through the analysis of what they have that there are stocks in their portfolio that they've had forever? Mm-hmm. Sometimes it works, sometimes it doesn't?
Yeah, sometimes these legacy holdings that they are emotionally attached to, that they want to keep in the portfolio. There's some sort of emotional attachment, and that's okay. But we just don't want it to be an over-concentration with these always individual positions that they want to keep, because then that can really affect their performance.
Right. That would be for a regular stock, but it's a little different with a company stock maybe that they work for, but then that's another thing.
Yep, that's a whole nother segment.
Whole nother segment and a whole nother thing we can help you with for investment and retirement planning, tax planning, and estate planning. We do it as a fee-only fiduciary. Trevor Nargis is a senior trader and part of the investment committee at Annex Wealth Management. Thanks for coming in.
Thank you, guys.
And Sarah Kyle, wealth manager at Annex Wealth Management. Thank you.
My pleasure.